You're listening to Kitchen Table Finance. Join Dave Shotwell and Nick Nauta as they cut through the complexity of financial planning and serve bites of investment advice that are both personal and practical.
Hey Dave, how you doing today?
I'm doing fantastic, Nick. How are you?
Wonderful. Welcome to Podcast Friday.
Back to Fridays.
Back to Fridays.
This feels right.
Sun is shining. Spring is sprung.
Sort of. Yeah.
Big things going on in Detroit next week. I know you're excited about them.
I heard that. Yeah. I'm going to stay as far away from Detroit as I can. Yeah.
Can't think of a better place for you to be than with 500,000 of your closest friends in downtown Detroit.
Right.
I'm shocked
right.
that you're going to stay away.
I'm a pretty deep football fan, but somehow attending the draft with 500,000 people did not get me excited.
Indeed. Well, good news for our listeners is we're not going to talk about draft stocks today, but we are going to talk about stocks.
Yeah, other stocks.
This is our welcome to our Q1 quarterly review and Q2 outlook. So with that being said, Dave, what do we got on the docket? Walk us through what happened in Q1 and go from there.
Q1 was pretty darn good, building on the back of a pretty strong 2023 across the board, right?
Yeah, I was kind of surprised by that, to be honest with you.
Yeah. Well, and remember the first 2 weeks of January as we kicked off the year were pretty forgettable, if nothing else. And there's that old I don't put a lot of stock in any of the pattern seeking, but there's an old adage that as January goes in the market, so goes the year. So I was not I was a little gloomy there by like right. January 15th or so. But right after that, shortly after that, we all of a sudden saw things take off, and we saw the S&P 500, the Nasdaq, Europe's Stoxx 600, the Japanese Nikkei. All those indices hit new record highs during the quarter. Yeah. And some of them repeatedly, like over and over the course of a few weeks, were hitting new highs.
Yeah. And the interesting part to me was it's not like we had a bunch of really good like economic news. Like we still had we basically repeated all the news from last year. And the market just kind of was like, oh, all right, well,
yeah,
whatever.
Yeah. It wasn't like any real positive surprises to the upside.
Right. Yeah.
And we saw the all cap world index, kind of our like broad barometer of the markets, positive 8.2%. That's pretty much counting every stock they can get a number for. That's a pretty solid increase.
Yeah, for a quarter, we'll take it, right?
Yeah, right.
4 more times this year, and we'll be real good.
Yeah. I don't want to point out to people what the annualized return at 8% a quarter was. Don't want to get anybody's hopes too high too fast.
Yeah.
So that's all good. The Fed, interest rates, and inflation continue to be the main story. The Fed is continuing their pause. We saw interest rates peak in July last year, 2023. Since then, the Fed has kind of paused. They're not raising rates, but they have yet to start lowering them.
Yeah, and I was as going through some of the stuff that Mario and East Bay puts together for us every quarter. There was a chart in here that made me pause and kind of get a little bit worried, and that was the CPI, the 6 month. Right? Everybody talks about the 12-month, but the 6 month has actually gone up a little bit, which is probably not a good sign. In terms of the grand scheme of where prices are and kind of the Fed's goal to get down to 2, right?
Right. Yeah, and it's like we came down from the very high inflation that we were seeing in the fall of 2022 down to around 3% and some change very easily. And now it's like it's kind of like losing weight, right? You lose a whole bunch all right away, and then after a while, what you're doing doesn't work as well. You gotta try a little harder, right? And it seems like we're kind of at that plateau. And there's talk of it. Basically, it's almost like we have 2 different economies right now, whether you're looking at like manufacturing kind of stuff versus services.
Yeah.
And in the manufacturing sector, those, speaking kind of with broad brushes here, but we're seeing inflation come down and be under control, while in the service industries we're still seeing wage pressure, we're still seeing inflationary pressures there, and that doesn't show any signs of lessening right now.
Yeah, going back, and I guess I probably should have gone back before I'm going to say this, but it seems to me, well, that inflation has been on both like the positive and reasons for concern slide.
Right.
Right? It's
Well,
like both sides of the ledger because we just don't
yeah,
know exactly
yeah.
what's going to happen,
Yeah,
right?
and
Like
that's
it
the
looks like
nature
a
of an
soft
inflection
landing,
point,
but
though, right? I mean,
right, yeah,
we're kind of like, it's like the roller coaster's ridden to the top, and now you're like teetering there, waiting for like
right,
when are we gonna come back down?
yeah,
And yeah, that's kind of the nature of it. And um, at the end of 2023, the expectation was we would see 6 or 7 interest rate cuts by the end of this year,
right,
based on the idea that the trajectory was down. Then we've kind of plateaued. Now the expectation is built into the markets is 2 or 3 at the end of this last quarter. And
right,
actually, the news since the end of March has kind of indicated that even that may be a little bit rosy.
yeah,
And we've seen the markets come down off those highs because of it. The market would
right,
love to see interest rates go down.
yeah. It's in Mario's slide deck, and we'll post a lot of this stuff in the show notes. But there is such a thing as financial memes, Dave, and
Heard
Mario
that.
put one in there for us, just in terms of normal rate cycles are kind of escalator up, right, slow,
Yep.
controlled, and then elevator down, and we're
Yeah.
kind of in the opposite right now, where we took the elevator up, fast, hard rate increases. And now, as far as cuts go, it looks like it's going to be more slow, drawn out, as
Well,
opposed to like the flip side of that.
yeah, I looked at that slide, and my take on it is to take it with a grain of salt, at least looking at all the like recent cycle changes. They've all been catalyzed by something happening, right?
Right, right.
Um, the tech bubble crash, the housing market crash, the pandemic,
Mm-hmm.
those trigger the Fed to cut rates drastically because
Yep.
some other force was slowing the economy down and they needed to stimulate. And
Right.
right now, and I guess this is the nature of the soft landing debate versus a hard landing. They've raised interest rates without breaking anything, so hopefully now they can lower interest rates gradually, right?
Right.
And get
Yeah.
to what they're seeking is this elusive concept of a neutral interest rate, right?
Right.
Where and it's not zero, it's somewhere, I don't know, and this is just it. Nobody really knows what neutral is. It's
Right.
kind of like when you're driving on the freeway, right? And you've got up to speed, and now you take your foot off the gas, but if you take it off too much, you got to find that like
Yeah.
right spot, right?
Mm-hmm.
And that's what they're seeking, is that like what should the Fed Reserve, where should they set interest rates so that they're not stimulating the economy, they're not slowing the economy down, things are just kind of coasting, right?
Yeah. Right.
That's what they're seeking. And yeah, I mean, in a perfect world, they would start lowering interest rates gradually, and we'd get to a point where they're neutral.
Right.
Um, the fear is that all of a sudden something's going to break in the economy, right?
Right. Yeah.
And that's what's happened in the past, is they've raised interest rates on an escalator and had to lower them on an elevator real fast
Right.
because they had overdone it.
Right.
And we're not seeing that, but we're also not seeing inflation come under control the way we had hoped.
Yeah,
So
well, and it's a good point. Like, to going back to the analogy, if we have to take the elevator down, something's wrong,
yeah, right,
right?
something's broken. Yeah, 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 you
and
got to
and
lower them
and
in a
the
hurry.
the flip side of that is we took the elevator up because inflation kind of came out of nowhere, and it came fast and hard, right?
Right, right, right. So um yeah,
I
the
think
jury's still out, and that's
Right. And I think inflation is one of those things we're going to keep talking about for a while. It's not going away, right? It's heard an
Yeah.
interesting thing on what's the podcast NPR does?
Oh, Planet Money.
Planet Money to this morning about like how, from a consumer standpoint, groceries are a big thing because you see, you
Hmm.
go to the grocery store every week or every 2 weeks and you see those price increases. They're constantly in front of you, right?
Yeah.
Nobody talks about wage increases because it usually comes once, it goes into your paycheck and you quickly forget about it, right?
Yeah.
And if you
Yeah.
look
You
at, like, if you
absorb it.
stand back and look at the numbers, like, wages are going up faster than prices are going up. So more than likely you're in a good spot. It just doesn't feel that way.
Yeah. Well, and it also like we deal with a lot of retirees on fixed incomes,
Mm-hmm.
right? And the corollary there is obviously their wages aren't going up. They don't have wages necessarily, but their portfolio has gone up
Yeah.
over the last, 18 months.
Yep.
And while yes, your prices at the grocery store are higher, there should be more room to increase income, increase draws,
Right.
kind of the corollary of that if you've invested properly. So, um, or if you're a saver, you're making money on your savings account now,
Right.
you know, and
Mm-hmm.
uh, and that interest income helps offset some of the fact that eggs are twice what they were in 2019.
Yeah,
So,
for sure.
and I think it's another important point to make that don't confuse getting inflation under control with prices coming down, you
Right.
know, because that seems to be like when we talk to people, it's like, well, I'm still paying more at the grocery store. Well, yeah, you are, and it's not like the price of eggs is not. If prices are coming down, something's wrong too,
Yeah.
you know. And
Way worse scenario than.
right. We don't want deflation. Deflation
Mm-hmm.
is bad. And if we did see deflation, we would see the Fed cutting rates as fast as they can to
Right.
stimulate the economy. And the logic is this, right? Like as a selfish consumer, I'm like, well, yeah, sure, I want deflation. That'd be great, right? But what happens when there's deflation on a macro level? What do you do? What kind of buying decisions are you making? Are you going out and buying a car today?
Nope.
If
We're gonna
there's
wait for the price to
deflation,
come
you're going to
down.
wait because the price, if I just sit on my money for 6 months, the price will be lower, and it becomes a self-fulfilling prophecy and a downward spiral because then, you may go ahead and buy that car in 6 months, but two other people are going to look at it and go, well, now I'm going to wait because Nick waited and that drove the price down, and now we're going to wait and that'll drive the
Right.
price down even more, and that cuts off growth and
Mm-hmm.
is a contracting economy, and that's bad.
Yeah.
I don't want to get in over my head in this context, but
Yep. Long story
deflation.
short, be thankful that prices are going up, and the
Yeah.
goal is to have them go up at a reasonable rate, not at
Well, you
an
want
extreme rate.
inflation should rise at a rate, roughly in line with gross domestic product growth.
Right.
And that's why the Fed's target isn't zero. The Fed's target is 2%.
Mm-hmm.
And a lot of there's always going to be debate about, again, kind of like the neutral interest rate number, what's the right amount of inflation. It's a modest amount of inflation that recognizes that there's growth in the economy.
Right.
So yeah, just in general, inflation bad, deflation worse.
Yeah.
If you take nothing else away from this. So
I love
um
it.
I like to keep it simple. So we didn't do a very good job with our structure here this time, Nick, because usually we talk about positive signals and reasons for concern, and we've kind of hit on a
Yeah,
few
we
things.
jumbled them
So
up today a little bit,
just
but
to just to kind of recap on the positive side, we've got the fact that it was a very strong quarter,
mm-hmm.
8.2% on the all cap world index. More importantly, is that rally has broadened out a bit. We haven't talked
Mm-hmm.
about this yet, but that's a very positive sign. Last year was all about the Magnificent Seven tech companies that were booming based on AI growth, potential growth. And while we all benefited from that if we were broadly diversified and invested, it's a little scary when all of that growth is being driven by a very narrow subset of the market. And as we've seen things play out over the last, at least since mid-January, the Magnificent Seven has kind of sputtered along with a couple of their components not doing well at all.
Right.
And yet the market still had those solid returns overall, which means people are buying into the fact that the economy is fairly strong overall. They're not just betting on AI, they're betting on the overall economy.
Yeah.
So that's a good thing.
Mm-hmm.
And kind of our third positive signal is that there is still hope for that soft landing, that the Fed will
Right.
be able to lower interest rates slowly from here without anything breaking. And we'll still see some rate cuts this year without seeing unemployment spike or economic growth in general grind to a halt.
Yeah. Well, soft, maybe bumpy. Is bumpy a better word?
Bumpy, yeah. Well, that was Mario's word for it.
Yeah.
The on the reasons to concern side, the way they wrote it was, inflation is still elevated, and we expect a bumpy road as the Fed
Yeah.
tries to
Right.
get us to that 2% target.
Mm-hmm.
And the market wants those rate cuts.
Right.
And
Yep.
that makes stock future earnings are more valuable when interest rates are lower,
Mm-hmm.
and when fixed and safe assets like savings accounts, government bonds are paying less, then taking the risk in the stock market is a better trade-off.
Right.
So in general, that's how that works. And if we see rates get held where they are for longer than the market has priced in, we'll see stocks come down a bit, or at least be
Yeah.
volatile while the Fed's figuring it out.
Right. For sure.
So
another repeat on the reasons for concern that doesn't look like it's going away anytime soon is
Yeah.
the geopolitical risks.
yeah, the war in the Ukraine still is a slogfest and
Mm-hmm.
causes all kinds of concerns. The Middle East, the conflict in the Middle East has even, since the end of the quarter, has taken some turns with,
Right.
Iran and Israel, lobbing missiles at each other, and some interesting developments there. We really don't want to see that go any further from here in terms
Yeah.
of escalation. There's always
Right.
going
For
to be
sure.
conflict in the Middle East. I think I've kind of accepted that. Some of my early memories are newscasts of Marines in Beirut and things going on,
Yeah.
So, but we need some stability there.
And we've talked about this before, but both of those things potentially lead to inflation problems, right?
Right. Yeah. That's when, humanitarian issues, of course, are very important. But when, we're here to talk about the markets and finance, and the problem is that disruptions in the Middle East cause oil prices to spike. When they shut down the Suez Canal, that causes shipping issues. Those are all inflationary. And at the same time, the Fed's trying to fight other sources of inflation. It just it doesn't do any good when gas prices are spiking and supply chains are disrupted.
Yeah. Yeah.
So yeah.
And on top of it all, when we have done our every 4-year podcast on this already, but we do have a presidential election coming up
What's
this
that
year.
this year?
Not sure if people were aware or not, but
Yeah.
and I do have my new favorite chart thanks to East Bay and Mario.
I know.
And that is it's titled "Stay Invested Regardless of Your Political Views."
Yes. And it basically shows the difference between the cumulative difference of being investing $10,000 in 1896 and leaving it there, so 130 years,
Yep.
or if you're a Republican and you bought during Republican administrations and then sold and then bought back in, and vice versa if you were a Democrat. And boy, this chart is staggering, the difference of staying fully invested.
Yeah.
Yeah. I wish we'd had this a couple weeks ago when
I
we
know.
were recording our own little podcast on the topic.
Yep. Basically, very big mistake to be political with when you are an investor and when you are not. It's kind of the long and short of it, right? And we'll throw this chart into the show notes. But I thought that
for
was
the
really
actual
cool.
numbers here.
Yeah.
Yeah. The the bottom line, I thought they had the money quote in here too, that history happens to presidents, not presidents happening to the market. You
Yep.
know, and they basically show that during uh, every administration, there's usually something that causes a large decline in the markets, but ultimately the markets usually end up positive. So
Yeah, it's really, no escaping it. It's
yeah,
anywhere from, I mean, the best case scenario during your presidency was a 19% drop in the Dow Jones, and that escalated from there.
yeah, yeah.
So, with Herbert Hoover apparently getting the worst of it.
Well, there was this little thing called the Depression that
Yeah.
happened right then, and you know,
Somebody
uh,
had to be president during that,
somebody
right?
somebody had to hold the bag. Yeah. So anyway, um,
Oh.
so
Um,
yeah.
our
Oh,
last reason for concern here, Dave, the Chinese economy still challenged, impacting emerging markets.
yeah.
So there's a lot going on there, a lot to unpack there.
There is their commercial real estate. Basically, I don't know. I don't want to get. I guess this is different than getting political about presidential elections, but you know, when you try to manage an economy, a bunch of bureaucrats sitting in Beijing trying to manage an economy for several billion people, um, instead of letting market forces determine how many apartment buildings and
Right?
things you should build. This is what happens.
Yeah. Yep.
And it's a little it's interesting. China's kind of an engine in the world, even though their economy is not as big as some of the developed markets. So be interested to see how that plays out. They're an important market. They're an important producer. Um,
Hmm.
and we just kind of never know what to expect there.
Yeah, it's one of the risks, which is why there's been some big returns and some big rewards, but those all come with bigger risks, right? So if you look at like
Right,
the history of like how China has performed in emerging markets in general, right? It's not
right,
just China; it's all of those. Like
right,
yes, in long stretches they have outperformed the U.S. markets, but that doesn't come without the risks of what's kind of
right.
going on right
Lots of
now.
volatility. Right.
Right? Exactly.
And it's also why emerging markets are a small slice of the pie when we build portfolios. And we talked about that in our last podcast, actually, like how you
Yeah.
divvy things up amongst different subclasses.
Yep. For certain. Any parting words of advice for our listeners, Dave?
Oh boy. Stay invested, tune out the noise. Don't expect 8% every quarter, and
Yep.
enjoy it when you get it.
I love it. And to steal another steal from Mario, financial planning is a process, not an endpoint, right? Like this
Hmm.
is an ongoing, evolving.
Enjoy the journey.
Yeah, exactly. I love it. All right, Dave. Pleasure as always, my friend. Listeners, if you have any questions, feel free to shoot us an email at info@srbadvisors.com. We would love to hear from you. Thanks, Dave.
Thanks, Nick.
This is a Zedia Media production.